In this week's video, we'll examine the question, what does history tell us about stocks, a strong dollar, and rising interest rates? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Before we move on to 2016 charts, in this segment of the video, we're going to be answering one question and one question only. Is it in the realm of historical possibility for stocks to perform well in periods marked by rising interest rates and a strong dollar? This chart tells us why this topic is timely. This is the U.S. dollar index. This is 2015 where my cursor is, and this is the present day over here in 2016. Like many markets, you can see the dollar has been in a long-term consolidation box, and it recently broke out to the upside in a bullish manner. Cutting right to the chase on our question, here are two periods here. This is 1982 to 1984. This is the U.S. dollar index. You can see the dollar was strong during this period here, and the trend for the S&P 500 was also strong point to point. This is July of 1982, and this is early in calendar year 1985, and this is the trend for the S&P 500, and this is the bullish trend in the U.S. dollar. Similar situation here, 1995 to the year 2000. U.S. dollar point to point has a bullish trend, and over the same period, the S&P 500 point to point has a bullish trend. This is anecdotal evidence, but we're just asking, is it in the realm of historical possibility for things like this to happen? And the answer is a definitive yes. One of the reasons why the dollar was strong in these periods was they were marked by rising interest rates. Basic trend in the federal funds rate from early 1983 to late 1984 was a rising trend, much like the trend in the U.S. dollar and the S&P 500. Similar situation for the 1995 to 2000 case. Bullish trend in the dollar. The trend in interest rates is up, and a bullish trend in the S&P 500. Clients and regular viewers know that we've covered 1994 and 1995 in these videos in the past because much like the present day, this period was marked by a long-term consolidation box for the S&P 500 that started back in calendar year 1992. This is 1995 here. And as price moved back to the top of the box, an area that had acted as resistance in the past, early in 1994, the Fed was getting ready to raise interest rates. In fact, it announced an interest rate hike on February 1st, 1995. This is early February 1995, and you can see where price was on the day of that announcement. We have a similar situation in the present day. Our long-term consolidation box for the S&P 500 goes back to calendar year 2013 here. And like that 1994-1995 period, in the present day, the market is expecting, pretty much has baked into the cake, an interest rate hike in December of 2016. If we go back to the 1994-1995 anecdotal example, here's point A at the top of the box. The Fed raises rates again right here. We know that the longer we go sideways, the bigger the move that we can expect to get once we see either a bullish breakout or a bearish breakdown from the long-term consolidation box. And in this case, the stock market broke to the upside almost immediately after the Fed raised rates, and it moved up roughly 42% from this point here to this point here. Harder markets are typically followed by easier markets. How similar is this sideways period here to the present day? 1992 to 1995, the market was basically going sideways for 830 calendar days inside of this box here. How does that compare to 2016? The present day scenario has actually been even more indecisive. We entered this portion of the box 1,130 calendar days ago if we count to this higher high here above this level here. We just tied in the long-term consolidation box that we've covered in the past to this 1995 to 2000 example. Is there anything else that we've covered in the past that aligns with this period in here? The answer is yes. This consolidation period and rally here was covered from a different angle when we talked about the rare signal that had only occurred 10 previous times in the past 35 years. This is the NYSE weekly, and remember we used the 30, 40, and 50 week moving averages for illustrative purposes only. This bullish break from the consolidation box here coincided with the Fed raising interest rates. This also is the period where this long-term signal flipped back over to a full bore bullish look. And you can see for the remainder of 1995, 1996, 1997, and into 1998, we still had a full bore bullish look with price above all three moving averages, blue the fastest moving average on top, and the slopes of all three moving averages were positive. If we fast forward to the present day, we know that we do have a constructive look on the same, for illustrative purposes only, moving averages. This is the 30, 40, and 50 week as of the close on November 23rd. This video is being recorded on Friday the 25th. We actually finished up better than this. We were up 22 points. We finished the week up 31 points, meaning we still have this constructive look. And you can see this period is very, very frustrated in 1994 when we look at the same moving averages. We get that whipsaw, we get a bearish look, and then we flip soon thereafter back to a bullish look in early 1995, right after the Fed raises interest rates. Moral of the story, this looks similar to this period here from an indecisiveness perspective. Is there any other period that we've covered in past videos that can also be tied into the rising interest rate and strong dollar theme? The answer is yes. This is a November 17th tweet, 2016, from Bloomberg. The dollar just strengthened the most since 2003 versus major world currencies. If you know your market history, you know that 2003 was an outstanding entry point for the S&P 500. This is 2003 here, and this is calendar year 2007 here. So like the other periods that we've covered, we have a strong dollar here. We also have a trend of rising interest rates in this period. And we've covered 2003 in previous videos using that same long-term and rare signal with the 30, 40, and 50-week moving averages. This is early in calendar year 2003. You see we have a full bore bearish look with price below all three moving averages. Blue is on the bottom, and the slopes of all of them are down. And then in 2003, we flip over to a full bore bullish look here, telling us that the probability of good things happening is now higher, and good things did indeed happen from a long-term perspective. In a previous slide, we showed how these moving averages look for the S&P 500. This is how they look in the present day for the NYSE Composite. We went from an unfavorable look early in 2016 to more of an indecisive look, and now we're back to a full-bore bullish look. If you want to find the detailed and longer-term analysis using these three weekly moving averages, you can Google this title here, and you should be able to find the video on the Schiavocco Capital channel on YouTube. These anecdotal stories help us with questions like, is a strong U.S. dollar necessarily a showstopper? We've proven that it's not necessarily a showstopper. And these historical references and anecdotal stories will have absolutely zero impact on how we manage going forward. We'll manage the same way using the facts and the hard data that's in front of us today. These little anecdotal stories just happen to align with the facts and hard data that we have in front of us today. That doesn't mean that will be the case tomorrow or in 3 weeks or 3 months. We'll close out the video with some of the hard data and evidence from 2016. Long-term consolidation box in the present-day S&P 500 monthly. We're above the box on Friday, November 25th. Similar and constructive look for the NASDAQ monthly on Friday, November 25th, as well as the Dow Jones Industrial Average. This is a nice looking, strong buying power candlestick currently on the monthly chart of the Dow, and it's above the long-term consolidation box that price entered way back in May of 2013. We also have three constructive looking candles here, November 25th, NYSE weekly, to go along with the constructive look with the 30, 40, and 50-week moving averages. Long-term correlations tell us that we don't want to get too hung up on the US dollar index from either a bullish, neutral, or bearish perspective. This table was forwarded by one of our followers, and it comes from @MarketOutperform. Here's the Twitter handle. This table, what it shows is this is the change in the dollar index in calendar years, and this is the change in the S&P 500. And the takeaway here is the correlation between movements in the US dollar and movements in the S&P 500 are what I would call a silly string correlation. They're all over the place. This is the daily correlation between the S&P 500 and the US dollar index. And this silly string correlation is the reason why the US dollar index is not included directly anywhere in the CCM market model. Sometimes the US dollar and stock market go up in unison. Sometimes they fall in unison. Sometimes the dollar zigs and the stock market zags. Sometimes the stock market zigs and the dollar zags. The moral of the story in the present day, rather than wasting too much energy on where the dollar is headed and what the dollar is doing, we'll just continue to do what we always do and look at the data inside the model. The data in the model has much stronger long-term and consistent correlations relative to the stock market. Remember, after the election, we covered Trump's platform. Do we have any evidence in hand since last week's video that aligns with the concepts presented in that video a couple of weeks ago? The answer is yes. That video was published on November 11th. This is ETF performance between November 11th and November 22nd. A lot of the ETFs that we covered in that video and said ETFs that might benefit from a Trump presidency, they have done well. November 22nd of this week was a quiet volume day for SPY. Traded 31% below average volume on that day. XME, which is stocks related to base metals and mining companies, same exact session, November 22nd. It normally trades 4.9 million shares. It traded way above average and was up almost 5%. Instead of trading 4.9 million, it traded 7.4 million. Similar situation on November 23rd. SPY, or the S&P 500 ETF, traded 41% below average from a volume perspective. JJC, which is the copper ETF, normally trades about 62,000 shares a day. It traded 129,000 and was up over 3%. Earlier this week on November 21st, SPY also had a light volume session coming in 23% below average. XOP, oil and gas exploration, had a big volume session. Normally trades about 17 million shares. It traded over 22 million and was up over 4%. During the light volume day on November 23rd for SPY, IWD, which overweights in some of the friendly sectors that we've been covering. It normally trades about 2.7 million shares a day, traded 3.5 million and was up 0.36%. Remember, we also said that small and mid-cap stocks might benefit from a Trump presidency. Did we see any evidence of that during Thanksgiving week? The answer is yes. November 23rd, during a light day for volume for SPY, the Midcap 400 ETF traded well above average volume. It normally trades about 1.3 million shares. It traded 2.1 and was up 0.44% for the day. And notice most of these ETFs are closing at the session high. We already noted that November 23rd was a light volume day for SPY. DBB, the base metals ETF, traded above average volume on that day and was up 2.42%. Some ETFs are also moving relative to the strong dollar here. DXJ is the Japan Hedged Equity ETF, was up 1.34% on November 23rd. Big volume. It normally trades 4.6 million shares, traded almost 7 million shares on a very light volume day for SPY. Remember 2 weeks ago we talked about tax cuts. We could see much higher corporate profits and higher inflation that could benefit GDP, earnings, and industrial stocks. XLI on that light session, November 23rd for SPY, traded above average, normally 12 million shares, 15.5, and it was up 0.74%, and once again, notice closed near the session high. 2 weeks ago, we talked about Dodd-Frank and banks. November 23rd, light volume day for SPY. KRE, the regional bank ETF, was up on well above average volume, normally 6.8 million shares. It traded 8.8. And also notice, SPY was basically flat that day. KRE up significantly more than the broad market on strong volume. Tax cuts could benefit retail stocks. November 23rd, above average session, 3.9 million is a typical day for XRT, or the retail ETF. On this day, it traded 4.6 million shares, was up roughly 0.5%. On the same day, the S&P 500 ETF was basically flat, and it traded relatively low volume. The volume in these signs of conviction can help us understand, is the market still responding to the same topics that we covered over the past 2 weeks? Relative to that question, it can be helpful to look at some of our risk-on, risk-off charts. This is retail versus treasuries, XRT, relative to TLT. This is the look we want to avoid, that full-bore bearish look. If we're bullish for XRT, this is the look we'd prefer to see, the full-bore bullish look. And late in the trading session on Friday, November 25th, you can see we have a full-bore bullish look, a convincing bullish look here in favor of XRT. During Thanksgiving week, late in that shortened session, the market closed at 1 o'clock Eastern Time, XRT was outperforming TLT by over 3%. Just a different way to look at risk on, risk off. This is our DBB base metals that we've been talking about the past 3 weeks relative to TLT. This is the look we want to avoid. This is the bullish look or favorable look over here. Late in the session on Friday, November 25th, this looks a lot more like this constructive period here than this concerning period here in calendar year 2008. In terms of the big picture on Thanksgiving week, was the market still responding to this basic theme? The answer is yes. This is the full week performance for Thanksgiving week. These are our risk-on ETFs. These are our risk-off ETFs. High beta, hedged, industrial stocks, transportation stocks, mid-caps. These are 3 small-cap ETFs. These are regional banks, base metals, and retail. The average gain over Thanksgiving week for these risk-on ETFs that align with this story was 3.19%. These risk-off ETFs, these are 2 bond ETFs and an ETF related to the VIX, on average lost 1.53% over the same period. If we want to look at the S&P 500 in isolation, this is calendar year 2008. This is what maximum fear looks like. This is what confidence looks like here with blue, the fastest moving average on top here. Here, the fastest moving average, blue, is on the bottom. How do the exact same generic weekly moving averages look today? They look more like this favorable period here, and you can see we had somewhat of a waning look heading into the election, and now we are back to a clean, full-bore bullish look with SPY also making a new weekly high above the previous highs. A chart like this, as well as all the hard data tracked by the CCM market model, basically helps us answer this question. Given the facts that we have in hand today, are we allocated properly? If the answer is yes, you err on the side of leaving it alone. If the answer is no, we make adjustments to get back in line. We ask the same questions about our individual positions. Is this position still healthy? If the hard data says yes, leave it alone. If it's moved into volatility to respect territory, then we will make the necessary adjustments. The only way to do that properly is to head into next week with that always important, flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.